to talk about the fundamentals of the market and understand the picture of the market in order to create a better portfolio. Jigar, thank you so much for giving your time to ET Now. Mansi Dave this side. It's a pleasure talking to you this afternoon.
Likewise, Mansi. Pleasure as always. Thanks for inviting on your show.
Absolutely. Jigar, if we try and understand the market and try and feel the market for the last quarter, the market has seen and digested a lot, be it the tariff jitters, the global uncertainties, and also on the domestic front, not so great earnings season. At least the first half was challenging, FIS selling. But now with the onset of festivities and yes, of course, the auspicious festival and occasion of Ganesh Chaturthi is around the corner, we can only hope, pray and wish for a better market and one side upsurge, which is missing since good long time. What's your view on the market at present and how do you read the texture of the market?
Right, Mansi. So, festivities bring cheer. I don't know if markets would completely support this line of thought, but all of us can always wish and pray. Uh, the factors that sort of you brought to the front, if we evaluate all of them, there is a lot to get worried at the time when sort of the macroeconomy in India looks reasonably okay. So if you look at, for example, the tariff tantrums and related issues, looks like that sort of this is dragging out longer than all of us had hoped for, and India is caught in the crossfire. Uh, Clearly, this is part of a negotiating tactic. Eventually, it will get resolved. But till the time it doesn't, what it means for the US is also that the numbers of sort of tariffs remain elevated, which will eventually get passed on to in the form of higher inflation. And therefore, that has taken Fed so much time to essentially start cutting despite sort of slowing CPI numbers and lower employment. Going forward, I think with sort of what Powell said in the Jackson Hole meeting, there is a window that has opened up with regards to a rate cut in September. The policy differential between US and India, the repo minus the Fed fund target rate, is now only at 100 basis point at the upper bound, which is the lowest in 23 years. And should US cut, I think India should also be in the position to cut. But RBI will tread this with caution. And if you want, I'll be happy to elaborate that. But I think that is sort of broadly along the expected lines. With regards to how that translates, obviously the earnings growth you mentioned as well has been sluggish. First quarter numbers that have come out, theoretically, there are more hits than misses. But the consensus has started cutting earnings estimate for 26 and 27 for the first time since 2022. So 4 years of very strong, consistent earning expectations. And now, albeit there is a growth, no doubt, but the extent of that growth is being cut, every passing quarter. And with the GST that's happening, they will in total put about 4.5 to 5 lakh crores. So I'm adding state plus center income tax, states under the social spending scheme, and this GST at around 4.5 to 5 lakh crores, which is 1.5% of GDP. So very clearly that's meaningful. The contours of market will change in line with that as well. And then the market should largely follow, with one small caveat that if the timing of the GST cuts matters a lot, because if you're pushing GST, sort of the consumption beyond the festive season, then we'll have to wait till January to find out how corporate earnings fared. So with that caveat, looking forward.
All right, so January is when we'll really find out how, the festive season and the GST reforms impact the earnings. But hi, Jigar, this is Kanishka also joining in. You were just talking about earnings, right? And you did say that we did see more hits than misses. But in terms of sectors, where is it that you're finding more value now? Any sectoral rotations that you have made after this earnings season?
Right, Kanishka. So yes, not after this season, but we were broadly positioned for some sort of a recovery around the consumption theme. Although we believe, the contours of consumption will be very different. So you are unlikely to see a situation where staples do very well. I don't think people can buy more soaps and oil as it is. But sort of the entire YOLO theme, right? Your travel, transportation, hotels, those themes look reasonably good from an earnings standpoint. Whether they are investable sectors is something that needs to be watched. But cement is a very unlikely consumption candidate, which we like. So that is one part we are focusing on. And then we still like pharmaceuticals, specialty chemicals, and banking financials as a overall overarching theme.
Yeah, diagnostic, banks and financials, and yes, of course, cement sector, even negating the seasonality factor, we have seen a few cement players doing really well. So I hear you there, Jigar. Another question on the currency front. Now, given the current inflection in labor data and Trump tariff, plus the currency stance, do you think a weaker USD could follow, especially if Fed guidance shifts towards cuts? And what's the comparison with the emerging markets?
Right, Mansi. So, see, the dollar index, which is the DXY, is what gets reported. That has fallen from almost 110 to slightly below 98 or thereabouts, around 98 levels. And we've done this study, which we have published in our July fact sheet, where if you look at the past 35, 40 years, you will find that the weaker dollar always results in an emerging markets outperformance. It's not one-to-one correlation, but graphically you can see that happening. And the reason for that is that if you are a global asset allocator, by being outside the US, you tend to generate a lot of returns just by virtue of your currency changes. And that is why sort of a weaker dollar always helps emerging markets. Now you have an incumbent government in the US, specifically Dr. Stephen Miran, who until now is the chairman of the Council of Economic Advisors to the White House. But Trump has already nominated him as a Fed governor. So we might very soon see him in a new avatar. And if sort of his word is taken, he put out a very large memo which argued for sort of US being devalued considerably. So if that were to happen, then it stands to reason that sort of dollar should depreciate against the global currencies, and that should benefit emerging market flows. Although with regards to INR, given sort of specific issues with India, the rupee has depreciated against the dollar. Secondly, domestic flows are becoming a lot more important than just global flows, right? So domestic, if you see a 12-month rolling number, then over the past 3 or 4 months, they are like 2x the global sort of flows. And domestic households savings coming to equities is still under 5%. At the peak of markets in 1992, it was almost as high as 15%. And developed markets, we know, are in high 20%.
Right.
So if that were to go up to 10%, you're talking
Right.
about reasonably decent flows.
All right, so domestic flows is what we are focusing on at the moment, but there are a couple of global cues also that we need to keep on our radar going forward in the year. Thank you so much, Jigar, for sharing those views and helping us understand the construct of the market as we speak. Thank you so much. On that note, we'll let you go. Lovely chatting with you.